You've seen this happen, right? That one friend who makes a totally reckless investment and actually wins big. It just defies all logic. While today, we're going to unpack exactly why some of the, let's say, least informed investors often seem to come out on top. And trust me, the answer is probably not what you're thinking. And it all starts with this one guy. Let's call him Dave.
So here he is, meet Dave. Now, Dave's been in the market for 2 years. To put that in perspective, in Wall Street years, that's basically a toddler who's just discovered a book of matches. He's old enough to cause some serious damage, but he has absolutely no clue what he's actually doing.
So, what does a guy like Dave do for fun? Well, his hobbies kind of paint the picture, don't they? He's getting his financial advice from watching The Wolf of Wall Street. His go-to pickup line at the bar is telling girls about emerging biotech stocks. And, well, he's zinning. A lot. To put it simply, Dave is absolutely convinced he's a financial genius.
And you know what? You almost can't blame him for feeling that way. His portfolio is up a solid 13% for the year. He just made an absolute killing on some random meme coin that basically went to the moon overnight. So yeah, right now his confidence is through the roof.
So, riding this massive wave of confidence, what does Dave do? He does what any, rational person would do. He gets on the phone with his broker, maybe fudges a few numbers about his net worth, and boom, he gets approved for options trading. He's ready to pour gasoline on this beautiful fire.
So let's take a look at Dave's trading plan, shall we? His strategy? Simple. Buy high and sell higher. What about risk management? Oh, that's easy. Just prayer. And the first sign of trouble? Well, his wife is starting to ask some pointed questions. Like, honey, where did that $13,000 from our savings account go? And then, of course, reality hits. And it hits hard. The Fed hikes interest rates, the market takes a nosedive, and all of Dave's leveraged bets just completely implode. His portfolio is now down a whopping 67%. And suddenly, his wife's new favorite hobby is browsing divorce lawyer websites. Ouch. Okay, so Dave's story is a total disaster, a classic cautionary tale, right? But it brings up a really important question. If this is how it always ends, how is it that we see so many investors just like him winning big, even if it's just for a little while? So let's ask it again. Why do the dumbest investors win?
All right, to really get this, we have to start by looking inside Dave's head, because it's not just about the market conditions. A huge part of this is psychology. It's about why he feels like a genius in the first place.
So the first piece of the puzzle is a fascinating psychological quirk called the Dunning-Kruger effect. The best way to think about it is like Darwinism for the stock market. Basically, it's a cognitive bias where people who have very little skill at something wildly overestimate just how good they are at it. This curve really lays it all out. Our buddy Dave, he's sitting right up there at the tippy top of what they call Mount Stupid. He is just blissfully unaware of his own incompetence. So when he wins, it's because he's a genius. But when he loses, that's just market manipulation. Meanwhile, the people who actually know what they're doing are way over on the right. They often underestimate their own skills because they're smart enough to know just how much they don't know. But okay, Dave's psychology is really only half the story here. The other piece of the puzzle, and honestly it's probably the bigger piece, is the environment he was investing in. So let's zoom out for a second and look at the big picture.
Just look at that number for a second. 715%. That is the massive, truly historic return of the S&P 500 over the last decade and a half or so. It's just a staggering figure, and it puts everything we're talking about into a whole new perspective. The truth is, we have been living through one of the greatest, longest bull markets in history. Ever since the financial crisis back in 2009, the market has been on this just unbelievable, unprecedented bender. And in an environment like that, you know the saying, a rising tide lifts all boats, even the really leaky ones. And here's the really crazy part. This kind of market actually rewards the Daves of the world. See, traditional investors are busy looking at things like fundamentals and value. But in a massive, everything is going up bull run, the biggest winners are often the people who just chase the riskiest, most irrational stuff they can find. Their recklessness has literally been rewarded. Okay, so how does this actually work on a mathematical level? There's a core financial concept that explains exactly why Dave's super high-risk approach paid off so well, at least for a while. And it all comes down to one little Greek letter, beta. This is the real aha moment.
So what the heck is beta? Let's break it down real simple. Beta is just a way to measure how volatile a stock is compared to the market as a whole, okay? So if a stock has a beta of exactly 1, it pretty much moves in lockstep with the market. If it's above 1, it's more volatile. And if it's below 1, it's less volatile. Simple as that.
Let's use a real-world example to make this stick. Take a company like Amazon. It has a beta of around 1.33. All that means is it's about 33% more volatile than the S&P 500. So on a day the market goes up 2%, you'd expect Amazon to go up about 2.66%. Awesome, right? But, and this is the part people forget, if the market falls 2%, Amazon is expected to fall 2.66%. It is a double-edged sword.
And this fake Warren Buffett quote, it perfectly captures the mindset we're talking about. The Daves of the world aren't interested in the slow, steady, low beta growth of a stock like Apple. No way. They want the crazy, explosive, high volatility moonshot potential of something like Fartcoin. They are actively chasing high beta assets.
Okay, so let's bring this all full circle. Let's get back to Dave and see how this one concept, beta, perfectly explains both his incredible, genius-level rise and his spectacular, life-ruining fall. This really just lays out the two sides of the high beta coin, doesn't it? In a rip-roaring bull market, Dave's super risky portfolio makes him look like the next George Soros, booking tables at Nobu. But when the market turns sour, that exact same volatility absolutely crushes him, and he just becomes the next viral loss porn post on Wall Street Bets.
So after all of that, after Dave's wild ride from genius to zero, what is the real takeaway here? What's the one lesson we should all remember?
It really just boils down to this one simple, powerful truth. Everyone is a genius in a bull market. It is so easy to confuse pure, dumb luck with actual skill when that rising tide is lifting every single boat. An insane market run can make even the dumbest strategies look brilliant, but it doesn't make the investor a genius. It just makes them lucky. So, I'll leave you with this to think about. The next time your friend, or your cousin, or some random guy at the bar starts bragging about how they hit a 10-bagger on some new meme coin, what are you going to remember? Are you going to see a financial wizard standing in front of you? Or are you just going to see another Dave, riding a big wave that could come crashing down at any second?